Welcome to Chapter 3, The Optimum Quantity of Money. This is going to be a really interesting lecture. It's going to be covering a paper written by Milton Friedman in, I think, like 1968, 1969, something like that. But it's still incredibly influential today, and the results from Friedman's analysis here are still used today. So this is really going to be like a bedrock of sorts, like a foundation for a lot of the monetary theory that we'll be getting in the remainder of the course. So last time we talked about two different models of the liquidity preference of money demand. We had the Baumol-Tobin model and then the money in the utility function model. And both of these models give us some pretty interesting implications. One of them is what the optimal interest rate is. And it's actually the optimal interest rate is the same in both models. So the question really is, what interest rate should the central bank set in order to maximize social welfare? And, well, we can go to Milton Friedman to answer that effectively. So, who was Milton Friedman? Well, he was this absolutely brilliant monetary economist. He got the Nobel Prize for his work on the permanent income hypothesis, which isn't monetary economics, but he did a lot of research on monetary economics, monetary theory, all that cool stuff. And in like the 1950s and 1960s, he was really on the leading edge of a lot of monetary economics and monetary theory, like research coming out of the School of Chicago's, the Monetarist School of Economic Thought. So, in this paper in 1967, so okay, I do state it eventually in the slides. Good for me. Friedman talks about the effects of increasing the nominal money supply, and then from this talk, it kind of enters into a discussion about an optimal interest rate that gives money the same return as other assets, and that is like the social welfare maximizing interest rate, or the price of money. So Friedman starts the paper off with a nice little thought experiment. So consider there's already a set amount of real money balances that you like to hold as savings. So I think he says it's like 1.5 times your monthly earnings, or like it's like, what, 5.5 weeks, something like that in the paper, which you will be required to read. It's an excellent paper. You definitely need to read it. Now, so you've got this amount of real money balances that you're holding. And there's a helicopter that flies over, and this is, a small closed economy. The helicopter flies over and drops a bunch of money, exactly doubling everybody's cash balances. Now, if that happens, what would you do? Well, Friedman suggests that what you would do is go out and spend all the money that you got, and everybody else would do that too. And as everybody tries to do that, prices and nominal wages will rise. Why would this be? Well, you try to spend more, but your expenditures are somebody else's receipts. And so the community as a whole can't spend any more than what they receive. You can really only spend more than you receive if you induce someone in that community to spend less than he receives. So if I'm spending more, this other person's spending less, you put our spending together, it still comes out to that the community as a whole can't spend more than it receives. Now, does this mean an increase in real output? No, it doesn't, because having more money doesn't mean there's more land, more animals, bushels of wheat, things like that, right? Just by magically printing more money, it doesn't mean we're magically printing more stuff into existence. We're just getting more money. So we really need to understand the distinction between the real and nominal quantities of money. So ultimately what happens is that people try to spend more than what they get, and they're frustrated in these attempts. As they're doing this in the process, they try to spend more than they receive or what they, produce, and it drives up the nominal values of goods and services. So more paper money doesn't affect the productive capacity of that society. If you choose to hold $10,000 in cash balances before, you would choose to hold $20,000 in money balances now. But in real terms, it's still $10,000. Now, there's no assumption really made in this paper about how this transition gets made, because it really depends on things like people's tastes and preferences, and Friedman doesn't really go too far into that. It could be something like producers could be slow to adjust their prices. There could be some overshooting, and if there's an overshooting, it could trigger like a cyclical adjustment pattern. On the other hand, prices could just simply double overnight. Prices could take a little longer to double. So, what if we didn't double the amount that everybody got? Suppose some people got more than others did. Well, if people got different amounts, we would have distributional effects that we didn't really have to think about before. During this transition, some people would have net gains in consumption, others would have net losses in consumption. And after the transition, everybody's in a situation that they could have been in earlier if they wanted, because real values didn't change. So it just changed the nominal money amount that you had in savings. So maybe what would have happened is they would spend a little bit less or they would spend a little bit more in order to get their savings back to where they were prior to this shock in the money supply. So everybody goes back to where they were. But the thing is, the transition to that original equilibrium position isn't overnight anymore. It can't be. It's going to have to take some time. Because if you picked up more than your share of cash, you're going to want to spend the excess cash that you had over a period of time, but probably not immediately. And if you picked up less than your share of cash before, then you're going to have to save more until your cash balances get back to the initial level of balances they were before in real terms. But this can't happen immediately. It's going to take time to save up again, right? So this thought experiment that we went through gave us a couple of basic principles of monetary theory. The first is the central role of the distinction between the nominal and the real quantities of money. What is that? Well, if you increase the nominal quantity of money, that doesn't mean that you're increasing the real quantity of money. If you increase the nominal quantity of money and real activity doesn't change, what happens is prices will rise by the amount equal to that by which you increased the nominal money supply. Second principle, the equally crucial role of the distinction between alternatives open to the individual and the community as a whole. Another way to think about this is the importance of accounting identities. There's the flow identity, that the sum of expenditures equals the sum of receipts, and there's the stock identity, that the sum of cash balances equals the total stock of money in existence. Next, there's the importance of attempts of individuals to spend more than they receive, even though doomed to be frustrated, has the effect of raising total nominal expenditures and thus receipts. So you'll want to spend more than what you're getting, and in doing so, it ends up raising total nominal expenditures, but real activity doesn't change. Next, there's the distinction between the final position and the transition to the final position, a short and long run dynamic kind of situation here. Because as we're transitioning to the final position, those distributional effects can actually have some real effects in output, but in the long run, that doesn't happen. In the long run, everything kind of settles back down to where it was. Next, the meaning of the real balance effect and its role in producing a transition from one stationary equilibrium position to another. Now, there were also two empirical generalizations of long-run monetary theory, and it's that the nominal amount of money is determined primarily by the conditions of supply, right? If we can supply more, you get more stuff being made. With more stuff being made, that changes the nominal and the real amounts of money. Well, assuming the nominal amount of money remains unchanged, if you're producing more stuff, the real quantity of money, the purchasing power of that money increases. Now, the real amount of money is determined primarily by demand and other variables in the system. So, if there was a one-time increase in the money supply, well, this is essentially illustrating monetary neutrality. What if the money increased continuously, though? So now money drops at a continuous rate of, say, 10% per year. And we're going to say money grows according to this function right here. M of t equals m naught times e to the mu t, where mu is the growth rate of money each year, and m naught is like an initial condition. It's the initial value of money. Or an initial amount, not really initial value, the initial amount of money that we have. Now, we're going to assume that each person gets a share of the new nominal balances equal to the percentage of nominal balances he initially held. So this is what we would get. we would have the log of money here, and plotting out the log of money against time, and it would be flat all the way up until this point where the helicopter comes in and drops money, but it does so continuously. And as such, it increases the growth rate of money. This mu term right here is what's driving the growth rate in the money stock, the nominal money stock. Now, individuals would be expected to respond to this continuous increase by keeping real money balances unchanged. So all real magnitudes would remain unchanged. If there were no frictions, meaning there's like nothing to stop anything from moving or adjusting accordingly, prices would just increase at the same rate that money balances increased. Think back to the quantity theory of money. It would be a situation similar to that what we saw in the quantity theory of money, where money was neutral and the elasticity was equal to 1. So in which case you would have the percent change in money equals a percent change in prices. So if that's the case, prices increase as P of T equals P naught times E to the mu T, where the mu is the growth rate in prices. So mu, it's the exact same mu, is what we had right here. So if I were to plot out, this is the change in the log of money. If I were to plot out the log of prices, it looks like the exact same thing. All you do is just switch out the P. So the growth rate is still the same. Now, granted, the level is going to be different because, well, the price level isn't equal to the level of the money supply. That would be silly to assume that. However, the growth rate of the money would be equal to the growth rate in prices, thus the rate of inflation. Now, if prices don't rise all at once, there's that transition period we were talking about. We would end up at the long-run equilibrium with that situation described before. And in that case, individuals eventually restored their initial real money balances. So if all markets are cleared and real magnitudes are stable, why do prices go up? Well, it's because literally everybody expects them to. And what would make this stable in this case? Well, ultimately, the cash balances would be rising with income. So it is a stable equilibrium, long-run equilibrium. And here, each individual is still going to try to spend more as they get more money. But as they do that, incomes will be going up. And as incomes go up, we try to save more in cash balances. And nothing changes in real terms. Everybody thinks they can spend more, but the community as a whole can't spend more. So they end up not being able to spend more in real terms. And prices increase by the same amount that they spend in additional nominal dollars. So let's talk about this transition process. We can have like a single overshooting and a gradual return to the permanent growth rate. There could be an initial undershooting followed by an overshooting and then a cyclical convergence to the new growth rate in prices. But why would there be any over or undershooting to begin with? Well, suppose the steady stream of money, of that money drop, starts. It's going to take time for people to catch on to what's happening. So they may initially let their actual balances exceed the long-run desired balances because they could maybe take the initial price rise as a sign of price drops in the future. Could also be because the initial effect may be on output rather than prices, and we're going to learn a little bit more about that when we get to the new Keynesian model. But as people start to catch on, prices end up rising even more rapidly than they would have otherwise to offset that initial increase in real balances, and that produces a long-run decline in prices. Now, there could be permanent distributional effects. Some people could get a continuous stream of cash that's greater than what they would like to be saving. So it's thus not in proportion to their initial cash holdings. Others could get less. The first would be enriched relative to the second, and they'd play a larger role in determining the structure of production or output. And Friedman's actually kind enough to give us an example here. There's a retailer who can economize on his average cash balances by hiring like an errand boy to go to the bank and exchange the smaller bills for the larger ones. Say it costs 10 cents a dollar per year to hold on to an extra dollar of cash, hence a 10% inflation rate. There's a greater incentive to hire that errand boy, thus substituting out other productive resources for cash. And this would therefore imply a reduction in the real flow of services from the given productive resources. And since there are different productive activities, well, it can differ in cash intensity just as they do in, say, the labor and capital intensity. So you can end up having these distributional effects negatively affecting output in the economy. Now, these two examples here give us an idea of monetary neutrality. The first one, with that one-time helicopter drop, that's an example of monetary neutrality. There's a one-time increase in the money supply. And when we have that, under the assumptions of monetary neutrality, it only affects nominal variables in the long run. Friedman's example gave us an immediate response in only nominal variables because prices were fully flexible. In that case, well, that meant that prices could change immediately. There is an instantaneous jump in prices. Now, in the event prices are slow to adjust, it can maybe take more time, but we eventually converge to the same result. So, if nothing else, in the long run, we have monetary neutrality. The continuous increase in the money supply, that example was monetary superneutrality. A one-time increase in the growth rate of the money supply only affects nominal variables in the long run. Again, Friedman initially assumed an immediate response in prices, but if there were any nominal rigidities, prices could be slow to adjust, and you could have that under or overshooting that we talked about. So, if inflation causes a welfare loss, does deflation cause a welfare gain? Now, suppose we get a government that comes in and they tax everybody at 10% per year and they just burn that money up in a furnace. Well, prices would decline at a rate of 10% per year. And you would actually get a positive return for holding $1 of cash balances. Now, if we ignore the distributional effects, right? Everybody would be richer than they were before because they have larger reserves for emergencies because that dollar is increasing in value. It's continuously increasing in value now. So other resources are still available. So it looks like everybody's better off, right? That'd actually be misleading. You could have negative effects on your utility, like you are more concerned about the safety of your cash since it's always increasing in value. So if you have more cash that you're holding on to, well, you might need to hire people to protect you, might need security just to protect your money. And you end up holding more in cash than you do in other assets because if cash is appreciating at a rate that is faster than the rate other assets are appreciating or the rate of return of other assets, then eventually these extra real money balances end up absorbing the productive resources of the economy because you'd rather hold dollars instead of other assets. But maybe that would be implying there's a rate of deflation that's too high. But what if there's one that's kind of small? Could there be a net benefit? The answer is yes, there could be. But the question is, what is that rate? Clearly, there'd have to be a balancing point, right? If inflation is positive, it makes money costless to hold. It's still valuable for facilitating transactions, right? So you're going to want to hold some money. And you're also going to want to hold money in case of a rainy day. So if you hold more money, well, unfortunately, that's less that you can invest in interest-bearing assets, which means foregone interest earnings. In order to decide how much money you want to hold, you have to trade off the benefits and the ease, or benefits of ease and the convenience in carrying out transactions against the cost in terms of foregone interest earnings. So we would want to strike a balance between these two factors. Right? You hold more money when the cost is low, less money when the cost is high. But as long as these monetary instruments pay less interest than other securities, money's costly to hold, and consumers have an incentive to economize on its use. So if holding an additional dollar is costly for people with positive inflation, for the central bank, it's costless to produce an additional dollar. Now, that would be the case if inflation were positive or negative. Because if the central bank's going to print an extra dollar bill, what do you think the marginal cost of that is? It's probably close to zero. So if you increase the quantity of real balances, thereby reducing nominal money balances by more than prices are rising, the central bank can make everyone better off at no cost to itself. Consumers would benefit from these additional real balances because it's easier to carry out transactions and it costs the central bank nothing to do this. So if we eliminated these incentives to economize on the use of money, the central bank would eliminate the difference between the interest rates on monetary instruments and other securities. So how do we do this? Well, we start with some math. Let's start with the Fisher equation. So equation 5 tells me that the nominal interest rate is the sum of the real interest rate and inflation. But I can really just express it in terms of the real interest rate because this is going to be the better way to look at it. So I just subtract inflation from both sides. And what happens is we want to set the nominal interest rate to 0. Now, why are we doing that? Well, we're doing that because the nominal interest rate reflects the marginal cost of printing an additional dollar. If that marginal cost is essentially 0, and we want to have an equilibrium that is comparable to that under perfect competition, you would set price equal to marginal cost. Well, the price is the nominal interest rate, so we set that equal to 0. In that case, it follows that the inflation rate would be equal to minus the real interest rate. So if the real interest rate were, say, 2 to 3%, Friedman's arguments suggest the central bank would want to deflate at a rate of 2 to 3%. And this involves reducing the nominal quantity of money, but it would fall at a slower rate than the price level would, and the quantity of real money balances would be increasing. So what instrument here would get a 0 nominal rate? Well, it would be treasury bonds. So holding treasuries would have a 0 nominal return, but a 2 to 3% real return. And holding money increases in value at a rate equal to the real return on treasuries. So there's no cost for holding money, and there's, well, also no interest rate risk for holding treasuries. What's the point of this? Well, it implies, since the marginal cost of printing one more unit of currency should be equal to the marginal benefit of holding another unit of currency, marginal cost equals marginal benefit. So at the margin, we want this cost equal to the benefit, and we can actually go back to the theory of the firm. So if you remember, for the monopolist, right, this is the monopolist like production schedule, we'll say. Here's demand. Well, the marginal revenue is exactly half of demand, right? It's going to be half twice the slope of demand, twice as steep. And we've got marginal cost here. We're assuming a constant marginal cost. So let's say that this is our marginal cost when we want to produce when marginal revenue is equal to marginal cost. Now, the monopolist produces where marginal revenue equals marginal cost and then prices up on this demand curve. You could think of the central bank as a monopolist when it comes to printing money. So what they would be doing is they produce when marginal revenue equals marginal cost and then price it along the demand curve for money. But Friedman says instead of doing this, instead of pricing it up here, you price it down here, which is the perfectly competitive price. So in that case, what happens is you maximize consumer surplus. So if consumer welfare gets maximized, and this is the welfare maximizing price, well, we should theoretically just set the nominal interest rate equal to 0. It's the exact same idea as what we got over here, just instead of producing like goods, it's producing something like money. And then there'd be no cost to carrying money, so there'd be no welfare loss. So think of it like this, right? So the central bank has a monopoly over note issue or printing money. So if they're a monopoly, right, they can set a higher price than marginal cost. But in our case, right, the marginal cost is printing an additional unit of currency. Therefore, that's essentially 0. The nominal interest rate should thus also be 0. And if the nominal interest rate is 0, we've got a situation where the real interest rate equals a rate of deflation. And we get a social optimum when this happens. If this doesn't happen, right, there's a positive nominal rate, then people economize on cash balances to the point that the marginal benefit equals the marginal private cost, which is the nominal interest rate. So if the nominal rate is greater than 0, the price is greater than marginal cost, and there's an economic inefficiency. When the nominal rate's equal to 0, the marginal social benefit and the marginal social cost of holding money equalizes at 0. So the optimum quantity of money gets achieved when there's a rate of price deflation that makes the nominal interest rate 0. The yield on cash balances from this appreciation will just balance the cost of abstaining from consumption, which is saving, And for everyone that borrows to hold cash balances, the cost imposed by a rising real interest rate. Since it costs nothing in physical resources to add to real cash balances, these returns balance the costs. So, what does it have to do with the money and the utility function in Baumol-Tobin models? Why did I show you that at the beginning? Well, the reason I showed you that stuff at the beginning is these two models have the same optimal interest rate, and it's 0. And the money and the utility function model, a 0 nominal rate maximizes utility. Under the Baumol-Tobin model, it minimizes the cost of holding money. So why don't central banks do this? Well, for one, there's short-run stabilization policy. If you have a nominal interest rate greater than 0, well, you have a little bit of downward wiggle room in the event that the central bank wants to try to use monetary policy to affect real economic variables. Remember, they can do it in the short run under certain situations, certain circumstances. However, they can't necessarily do it in the long run because you've got monetary neutrality. Thus, if it's above 0, well, they've got a little bit of wiggle room, downward speaking. Because if you go down to the 0 lower bound, it's like an effective lower bound for interest rates. In the United States, it's 0. You can't go below 0 with interest rates. So if it's stuck at 0 already, you don't really have a whole lot of, well, actually don't have any wiggle room to try to lower rates to try to stimulate production. So that's really going to wrap up this chapter. I am assigning this chapter as readings. You're going to want to flip through chapter 3, but you're definitely going to want to read the optimum quantity of money. So I'll be posting that to iLearn. You guys can read that sooner rather than later would be good. And yeah, so that kind of wraps everything up with this. The idea would be the nominal interest rate on bonds would be 0. It'd reduce the nominal money supply, increase the real money supply, and thus increase the purchasing power for us. In doing so, it improves welfare. Now, not everybody liked this. Phelps in 1973 argued there's an inefficiency because there could be gains to welfare from creating money, which is called seigniorage. We're going to get to that later, where we look at like money and public finance related stuff. But that's a couple of chapters in advance, so don't worry about that just yet. Just focus on what we learned in this chapter. And, well, thank you for watching, and there will be more to come in the next couple of days.